Most traders stare at price charts and see patterns, waves, or signals. But what if the most reliable trend indicator is not a pattern at all, but a simple mathematical fact? Trends are the movement of market average cost. In this episode, we break down the mechanics of moving averages, the concept of cost carry, and how you can pre-engineer trend reversals using the price offset principle. We will show you why trends are not random, why volume reveals disagreement, and how time and space define your trading edge. No predictions, no guessing, just the math behind the market's cost structure. Welcome to DeepQuant. The idea is that every trade has a cost, and the average cost of all market participants shifts as new trades occur. This shift is what we call a trend. By focusing on the mathematical relationship between price and moving averages, we can identify when the average cost is likely to change direction, giving us a systematic edge without relying on subjective chart patterns. The market floods you with information, news, earnings, rumors, tweets. But most of it is noise. The key is to filter out everything except the most direct, real-time, and honest data, price and volume. These two variables capture every decision, every hope, and every fear of every participant. They are the raw material of trends. Over time, price and volume create a spatial pattern we call a trend. So when you read a chart, you are not predicting the future, you are reading the record of what already happened. The question is, what do you do with that record? The answer lies in understanding that price and volume are not just numbers, they are the collective actions of all market participants. By filtering out the noise and focusing on these two variables, you can see the underlying cost structure that drives trends. This record of price and volume provides the foundation for all our analysis, allowing us to make informed decisions based on evidence rather than speculation. A moving average is simply the average closing price over a set number of days. For a 5-day moving average, you add today's close plus the previous 4 days' closes and divide by 5. That gives you the market's average cost for the last 5 days. But here is the twist. To know if tomorrow's moving average will be higher than today's, you only need to compare tomorrow's close to the close from 4 days ago. If tomorrow's close is higher, the moving average turns up. This is called the price offset principle, and it is the engine behind every moving average crossover. The principle works because the moving average is a rolling calculation. As new data comes in, the oldest data drops out. So the direction of the moving average depends on the relationship between the current price and the price from a fixed number of days ago. This allows us to anticipate the moving average's direction without waiting for it to change, giving us a forward-looking view of the trend. A trend is not a line drawn on a chart, it is the direction of the market's average cost. When the moving average slopes up, the average cost of holding the asset is rising, which means recent buyers are paying more than earlier buyers. That is an uptrend. Conversely, a downtrend is when the average cost is falling. So to identify a trend, you do not need complex indicators. You just need to know whether the relevant moving average is rising or falling. And thanks to the price offset principle, you can calculate that before it happens. For example, if the 5-day moving average is rising, it means that the current price is above the average of the last 5 days, pulling the average up. This simple observation tells you that the market's cost structure is shifting upward, confirming the uptrend. By monitoring the moving average's slope, you can stay on the right side of the trend without getting caught up in short-term fluctuations. Let's apply the offset principle to a 20-day moving average. To know if the 20-day MA will turn up in the next few days, you need to see how the price 20 days ago evolves. If the price 20 days ago was high and is about to drop out of the calculation, the MA will turn up even if the current price stays flat. This is the power of the offset. For example, if the 20-day offset price is currently high and will decline over the next week, a flat price will cause the MA to rise. So you can set a price alert at the level where the MA will turn. This is not prediction, it is pre-engineering. You know exactly what price level will trigger the turn, so you can prepare in advance. By setting alerts at these critical levels, you can be ready to act when the market reaches them, without having to constantly monitor the charts. This systematic approach removes emotion and guesswork from your trading decisions. There is a fundamental difference between predicting and pre-engineering. Prediction is guessing the future based on patterns or intuition. Pre-engineering is using known data to calculate the conditions under which a trend will change. The price offset principle allows you to pre-engineer. You know exactly what price level will cause the moving average to turn. You then wait at that level, not because you predict it will be reached, but because if it is, you are ready. This is the necessary path concept. The price must pass through certain levels to change the trend. For example, if the 20-day MA is currently falling, but the price 20 days ago was high and will soon drop out, the MA will turn up if the current price stays above a certain level. That level is the necessary path. By identifying these levels, you can plan your trades with precision, knowing exactly what conditions must be met for the trend to change. How do you know when a trend is about to reverse? Two classic signals, the 2B structure and the moving average squeeze. The 2B structure occurs when a new low is made, then price quickly recovers above the previous low, indicating a failed breakdown. The moving average squeeze happens when short-term and long-term MAs converge, meaning the market's cost structure is aligning, often leading to a big move. Both signals are based on the idea that trends change when the cost structure changes. The 2B structure shows that sellers could not push the price lower, so the cost structure is shifting upward. The MA squeeze indicates that the average cost of recent buyers and longer-term holders is converging, suggesting that a breakout is imminent. By recognizing these patterns, you can anticipate trend reversals and position yourself accordingly, but always with the confirmation of price and volume. Volume is often misunderstood. It is not simply the number of shares traded, it is a measure of disagreement. On a day with huge volume, buyers and sellers are fighting fiercely, each convinced they are right. That disagreement creates volatility and often marks turning points. Low volume, on the other hand, means little disagreement, and prices can drift for a long time. So watch for volume spikes, they signal that the market is making a decision. For example, if a stock has been in a downtrend and suddenly volume surges as the price makes a new low, it could indicate that sellers are exhausting themselves and buyers are stepping in. This disagreement often precedes a reversal. By paying attention to volume, you can gauge the conviction behind price moves and avoid getting caught in false breakouts. Every trend operates within a time frame. When you analyze a moving average, you must consider how long it will take for the offset price to move in your favor. For example, if the 20-day offset price is high now but will drop in 10 days, you have a window. If the price rises too early, the MA may not turn because the offset is still high. If it rises too late, the opportunity passes. So you frame your expectations. Within the next X days, if price does Y, the trend will change. This adds a temporal dimension to your analysis. For instance, if you know that the 20-day offset price will decline over the next week, you can expect the MA to turn up if the current price remains above a certain level. This gives you a clear time frame for your trade setup, helping you manage your expectations and avoid premature entries. When you enter a trade based on a moving average turn, you must calculate the risk-reward ratio. Suppose you buy at $10.30, and your stop loss is at $9.40, a loss of 90 cents, about 8.7% of your capital. Your target is $22, a gain of $11.70, over 113%. That gives a risk-reward ratio of about 13 to 1. This is the essence of asymmetric risk. You risk a little to gain a lot. The moving average structure helps you define these levels objectively. For example, the stop loss can be placed below the recent swing low, and the target can be set at the next resistance level or a multiple of the risk. By calculating the risk-reward ratio before entering a trade, you ensure that you only take trades with favorable odds, which is crucial for long-term profitability. Space in trading is the distance between different cost levels. When moving averages cluster, they form a consensus zone. That zone acts as support or resistance. After a breakout, the next target is often the next cluster of MAs. So you can map out potential price targets by identifying where the market's average cost has previously converged. This gives you a ladder of targets, each representing a different level of cost agreement. For example, if the 20-day and 50-day MAs are close together, that zone is a strong support or resistance. If price breaks above it, the next target might be the 100-day MA, which represents a higher cost level. By identifying these clusters, you can set realistic price targets and manage your trades more effectively. Financial markets are amplifiers of human nature. Greed and fear are magnified by the crowd. When everyone is buying, greed takes over, and prices overshoot. When everyone is selling, fear dominates, and prices overshoot to the downside. This is why extreme deviations from the moving average often revert. The market is not rational, it is a reflection of collective emotion. Understanding this helps you stay objective when others are emotional. For example, when a stock rallies far above its 20-day MA, it may be due to excessive optimism, and a pullback is likely. By recognizing these emotional extremes, you can avoid buying at the top or selling at the bottom, and instead wait for the market to return to more reasonable levels. George Soros's concept of reflexivity explains why markets are inherently unstable. Participants act on imperfect information, and their actions affect the market, which in turn affects their perceptions. This feedback loop can lead to bubbles and crashes. In technical analysis, reflexivity is visible when price movements reinforce themselves until they become extreme. Recognizing this helps you anticipate turning points, not by predicting, but by understanding the dynamics of self-reinforcing trends. For example, as prices rise, more buyers are attracted, pushing prices higher, which attracts even more buyers. This can lead to an overextended trend that eventually reverses when the feedback loop breaks. By being aware of reflexivity, you can be cautious when trends become too one-sided and look for signs of exhaustion. In summary, trends are not mystical, they are the movement of market average cost. By understanding the price offset principle, you can pre-engineer when a moving average will turn, and thus when a trend is likely to change. Combine this with volume as a measure of disagreement, time frames for validation, and space for targets, and you have a systematic approach to trading. Remember, you are not predicting, you are preparing. You wait at the necessary path, and when the price arrives, you act with a favorable risk-reward ratio. This is the essence of quantitative trading. By applying these principles, you can trade with confidence, knowing that your decisions are based on mathematical facts rather than guesswork. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.